The millionaire and the janitor imagine two men. The first man is a graduate of Harvard University. He holds an MBA, climbs the ranks of Wall Street, becomes a vice president at Merrill Lynch, and is featured in major business magazines before he even turns 40. He is so wealthy that he expands his 11,000 square foot mansion in Greenwich, Connecticut, to include 2 swimming pools, a wine cellar, and 7 bathrooms. His name is Richard Fuscone. The second man is Ronald Read. He lives in rural Vermont. He walks to work, wears a denim jacket held together by safety pins, and chops his own firewood. For 25 years, he fixes cars at a gas station. For the next 17 years, he sweeps floors at a local JCPenney. If this were a movie about the American dream, you know exactly how this story ends. The Harvard genius conquers the world. The humble janitor struggles to pay his medical bills. But history does not play by Hollywood's rules. In 2014, Ronald Read died at the age of 92. When his will was opened, the entire United States financial sector gasped. The quiet janitor had left behind a fortune of $8 million. He bequeathed millions to his local library and hospital, leaving the rest to his stepchildren. Meanwhile, just a few years earlier, during the 2008 financial crisis, Richard Fuscone, the Harvard elite, filed for Chapter 11 bankruptcy. His massive mansion was foreclosed upon and sold at a fraction of its value. He reportedly stood before a bankruptcy judge, broke, stripped of his dignity, and utterly ruined. The question: how does a man with a broom outperform a man with an Ivy League MBA in the exact same economic system? The answer has nothing to do with intelligence, math, or luck. It has everything to do with a hidden flaw in human nature. This is the dark, fascinating truth about the psychology of money. Why incredibly smart people go broke. The illusion of the unsinkable ship. To understand why genius fails, we have to look at how smart people view risk. When you are highly educated, your brain tricks you into believing that because you can measure something, you can control it. Let's look at the historical reality of Richard Fuscone's downfall. In the mid-2000s, the American housing market was booming. It looked like a machine that only produced gold. Fuscone, relying on his decades of experience, heavily leveraged his wealth. He borrowed massive amounts of money to invest in complex real estate assets and to fund his ultra-luxury lifestyle. To a brilliant financial mind, this wasn't reckless. It was an optimized strategy. He looked at past data, calculated the probabilities, and concluded that the market could never crash hard enough to destroy him. He forgot the primary rule of human psychology: greed blinds even the sharpest eyes. When the subprime mortgage crisis struck in 2008, liquidity dried up overnight. The complex financial models Fuscone relied on shattered like glass. Because he had borrowed so heavily against his assets, he didn't just lose his profits, he lost everything. Now let's look back at Ronald Read, the janitor. Read didn't know how to price complex derivatives. He didn't understand advanced macroeconomic theory. What he did understand was patience and his own emotional limits. Every month, he took the small amount of money he didn't need and invested it in blue-chip stocks. He held them for decades. He let the most powerful mathematical force in the universe, compound interest, do the heavy lifting. For Ronald Read, end time was his weapon. For Richard Fuscone, R, the rate of return mixed with leverage, was his downfall. Finance is one of the few fields in the world where an amateur can outperform an expert. In medicine, a janitor cannot perform open-heart surgery better than a Harvard-trained surgeon. In physics, a gas station attendant cannot build a rocket better than a NASA scientist. But in money, behavior trumps credentials every single time.
The tragic genius of long-term capital management. If you think Richard Fuscone was an isolated case, let us take a journey back to 1998 to witness perhaps the most spectacular intellectual collapse in Wall Street history. Enter a hedge fund called Long-Term Capital Management, LTCM. If financial intelligence could be turned into a superhero team, this was it. The board of directors at LTCM included the smartest minds alive. It featured Myron Scholes and Robert C. Merton, Two men who literally won the Nobel Prize in economics for creating formulas to price options. The fund was packed with PhDs, MIT mathematicians, and Wall Street prodigies. Their strategy was flawless on paper. They used highly sophisticated mathematical models to find tiny discrepancies in bond prices around the world. Because these discrepancies were small, LTCM used extreme amounts of leverage, borrowing up to $30 for every $1 of their own money to magnify their profits.
For the first few years, it worked beautifully. They made astronomical returns. The founders became billionaires. They were hailed as the smartest men in the room. But their models had a fatal flaw. They were based on historical data. They assumed human beings would always act rationally based on past patterns. In August 1998, Russia did something the models said was statistically impossible. The Russian government defaulted on its domestic debt and devalued the ruble. Panic spread through the global financial markets like wildfire. Human psychology took over. Investors didn't act rationally. They acted out of pure, unadulterated terror. They fled to the safety of U.S. treasuries, causing the exact opposite of what LTCM's Nobel Prize-winning formulas predicted. The crash. In a matter of weeks, LTCM lost $4.6 billion. The smartest men on Earth were losing $100 million a day. They were leveraged so heavily that their collapse threatened to take down the entire United States financial system, forcing the Federal Reserve to step in and orchestrate a multi-billion-dollar bailout. How did Nobel Prize winners go broke? They forgot that a spreadsheet cannot capture fear. They forgot that when the market panics, your IQ doesn't matter. If your strategy requires the world to always be rational, your strategy is doomed to fail. The psychological traps of success. Why does this happen to smart people over and over again? Why do we see brilliant doctors, elite lawyers, and tech CEOs earning seven-figure salaries, but living paycheck to paycheck, or worse, facing financial ruin? Psychology reveals three distinct traps that specifically target the highly intelligent. 1. The moving goalpost syndrome. The hardest financial skill is getting the goalpost to stop moving. When smart people achieve success, their tastes change. They move into wealthier neighborhoods. Their peers change from middle-class professionals to millionaires. Suddenly, a $500,000 income feels small because their neighbor makes $2 million. As author Morgan Housel notes, comparing yourself to others is a battle that can never be won. The only way to win is to accept that you have enough, even if it's less than the person next to you. 2. Overconfidence in transferable genius. If you are a brilliant neurosurgeon, you are used to being the smartest person in the room. You spent a decade mastering an incredibly difficult craft. This creates a dangerous cognitive bias. Because I am a genius at surgery, I must also be a genius at investing. Smart people often reject simple financial advice, like buying basic index funds, because it feels too boring for their superior brains. They seek out complex, high-risk investments, angel investing, or speculative assets, because they believe their intellect gives them an edge. It rarely does. 3. The confusion of wealth versus rich. Rich is current income. It's the Ferrari in the driveway. It's the first-class ticket to Cabo. It is highly visible. Wealth is invisible. Wealth is the option premium you didn't buy. The luxury car you didn't lease. The stocks you haven't sold. Wealth is financial freedom. smart people are exceptionally good at getting rich, but their psychology often prevents them from staying wealthy. They use their massive incomes to buy status symbols, leaving them vulnerable to any sudden disruption in income.
The only dividend that matters. Let's return to our janitor, Ronald Read, and our Wall Street executive, Richard Fuscone. Their stories prove a profound truth. Doing well with money is not necessarily about what you know. It's about how you behave. You can have all the degrees in the world. You can understand the most complex mathematical formulas. But if you do not have control over your greed, your ego, and your need for social validation, your intelligence will only help you go broke faster and more spectacularly. Money is heavily emotional. It is wrapped up in our insecurities, our desires, and our fears. The smartest thing you can do for your financial future is not to find the next hot stock or create a flawless algorithm. The smartest thing you can do is to build a massive margin of safety into your life, to practice humility, and to recognize that true wealth is the ability to wake up every morning and say, I can do whatever I want today. Ronald Read died wealthy because he mastered his behavior. Richard Fuscone went broke because he let his ego write checks his future couldn't cash. The next time you look at your finances, remember, your spreadsheet doesn't care how smart you are. The psychology of money is undefeated. Manage your mind, and your wallet will follow.